One of the most overused words in the financial industry is what? Diversification. You hear it all the time. But today I want to talk about a different type of diversification. One that can make just as much, if not more of an impact on your future retirement. It's called tax diversification. And it's the one way that you can get control of your income and get Uncle Sam disinherited from your wealth long-term in retirement. Let's go. Hey everybody, Chris Herline here, partner at REAP Financial. Thanks for tuning into our channel today. We talk about your life and money. We want you to make smart decisions with your wealth. If you like what you see, hit the subscribe button, give us a thumbs up down below. Tax buckets create choices in retirement. And when we talk about tax diversification, it means we want you saving in a way through your working career or even post-retirement positioning assets. We gotta do this in a way that it's gonna give you flexibility, it's gonna give you control when it comes to your taxes. The myth is that when you retire, you're gonna be in a lower tax bracket because the paycheck goes away. But for the successful families that we consult with, in many cases, that's not what happens. And the scary thing is we're at 40-year low tax rates in this country. And the reason's this: the bulk of families' wealth in America has been saved in IRAs and 401ks. And you do that along the years because you like tax deductions. And so as you're watching this right now, if you think about what the largest accounts are that you and maybe you and a spouse have, where is it? Is it in the bank? Is it in a brokerage account? Is it in a Roth IRA? Probably not. It's in your 403B, your IRAs, your 457s. That's where the bulk of Americans' wealth has been saved. And so when we talk about tax diversification, you need to understand that all of the money that I just mentioned, those accounts are all gonna be taxed differently come retirement. So the first bucket is going to be taxable money. And when you consider inflation as high as it's been the last couple of years, it's painful when we think about our money at the banks because the banks aren't paying any good interest yet. And so I always used to say, if you're heavy in the banks, you're losing money safely. And it's not just because of inflation, it's because it's taxes. Think about this. If you have a 1% bank CD out there or a money market that's kicking off a little yield here and there, even if you don't touch that money throughout the year, at the end of the year, you get a 1099 and you're paying tax on the dime a month of interest the bank's been giving you. And then you factor in the loss of inflation. See, the thing is that if you need control in retirement of your tax bracket, we need to start by looking at where are you paying taxes on money that you're not even using? And you'd be shocked. So many people are, maybe you are. And it's because of dividends that are being generated in your brokerage accounts. Maybe you're reinvesting those. It's also because of the banks. You've got to have a nest egg there, and you're probably getting a little bit of interest. But after you pay tax at the end of the year, it's pretty painful. But that's a taxable bucket of money. Brokerage account falls in there as well, right? If you sell highly appreciated stocks, you're gonna pay capital gains at maybe a 15 or 20% rate. But if you have dividends in your investments, which a lot of retirees do, some of those dividends may be taxed as ordinary dividends. Some may be taxed as qualified dividends. We want qualified dividends. Qualified means that income, whether you're taking it or not, is being taxed at capital gains rates. Ordinary dividends means you're being taxed at your marginal income rates, which is generally going to be higher. So are there ways to reposition your portfolio in a way that you can reduce the dividend income that's shown up on line 3A and B on your 1040? There probably is. But again, that's the first approach. So number one is our taxable bucket. The second one is obviously our favorite one. It's the tax-free bucket. And it's not just Roth IRAs. You understand, you put money in a Roth, you don't get the tax deduction today, but that money will forever grow tax-free. You could put $1,000 in there, it grows to $10,000, $100,000. It's all yours. My favorite thing about a Roth IRA is that it's not subject to required minimum distribution. We talk about that in a lot of our other videos, but the required distribution is what can create a massive tax bomb for retirees. So it gives you control, plus you leave the Roth IRA to your heirs tax-free if that's of value. But there's another account out there that's even more powerful than the Roth. It's called a health savings account. And a lot of you may have access to one, you're not utilizing one. Why is it so powerful? When you put money in a health savings account, you get a tax deduction. You don't get that with the Roth. That money can be invested in most cases, and then when you pull it out for qualified medical expenses, guess what? It can come out tax-free. Not just what you put in, but all the growth. It's like a super Roth. You've got the tax deduction on the front, it comes out tax-free. Now here's a little secret. How do you turn your doctor's bills into tax-free retirement income? Well, put money in your HSA each year, get a tax deduction. When you have a doctor's bill, a copay, a prescription expense, self-pay. Don't pull out the checkbook or the debit card on the HSA. Now you're really confused. For you engineer mind out there, here's a new spreadsheet. Keep track of all your medical expenses. Could be for a couple years or for decades. When you go to retire, now you've amassed money in this health savings account. You've had qualified medical expenses along the way. You tally those up, and now when it's time, you can cut yourself a retroactive reimbursement check tax-free every medical expense you had. The tax-free bucket allows you to reduce your income in retirement. Number 3, the estate tax bucket. Now, many families right now here in 2022 are not so worried about estate taxes. That's because estate tax limits are so high. Unless you and a spouse are leaving over $23 million this year to heirs, you don't really care about estate tax. And even if the current administration brings it down to around $12 million, most Americans aren't going to need to worry about that. But as your wealth grows through the years, there has been talk in DC about maybe bringing those limits down to $3 million per person. If that were to pass, a lot of you watching this right now may be subject to that, maybe not just today, but over the next 20 years as your wealth continues to grow. So an estate tax bucket could be where a family that has assets that they know are earmarked to their heirs or causes they believe in, they can use those assets, put them in an estate tax bucket, potentially in a life insurance policy, and that money then goes tax-free to the heirs. Now, there's elaborate trusts that can be set up around a life policy as well. But this is money that in many cases families are using to enhance their legacy, leave more, or setting aside to pay for estate taxes. Keep an eye on that one, as the limits will be changing in years to come. If this is striking a chord and you're wanting to see how to reposition assets, get your hand on my report. It's free for all of our YouTube viewers. It's the 4 tax buckets and how buckets can give you choices and flexibility in retirement. Email me right now, retire@reapfinancial.com. That's retire@reapfinancial.com, and my team will have it on its way to your inbox.